Hey Brew Crew, Brewer here. Welcome back to another video. Today I wanted to talk about long verticals or debit spreads as some might call it in the Robinhood world. If you've ever bought a vertical and wondered why it's hard to make money, here are 3 important reasons. First is, you've made the distance between the long and short legs too narrow. This one is the most obvious. Your long vertical has a directional component to it, meaning if the underlying moves in the direction of your bias, you make money and vice versa. However, this means that if your vertical is too narrow relative to the average movement of the underlying, then the difference between the delta of the long option and the delta of the short option is going to be close to 0, meaning you're not going to make much money, especially when there's still a lot of time left in the spread. As an example, let's assume you buy the 118.75, 121.25 long call vertical on Apple for the September 18th expiry. This is the risk graph here. Looking at the pink curve, which represents the P&L curve for today, you'll notice that as Apple moves from where it is now to 125, you'll make only 29 cents. To make more, consider spreading your legs further apart. Choosing a 115-125 vertical yields roughly 117. Just know that wider verticals means higher initial debit and more downside risk. Second reason it might be hard to make money with verticals is there's still a lot of time left before expiration. When there's still a lot of time left before expiration, assuming your vertical is slightly in the money, at the money, or out of the money, your short leg is going to contain a lot of extrinsic value. In order to overcome this extrinsic value, you need the underlying to move a lot further in the direction of your bias to cause both legs of your vertical to be deep in the money in order to counteract and reduce the extrinsic value in the short options. Taking a look at the Apple example again, let's say now instead of looking at the 115-125 long call vertical for the September 18th expiry, we instead looked at the 115-125 long call vertical for the monthly October expiry. Notice now, if Apple reaches 125 right now, the vertical now only yields 76 cents in profit versus $1.17 from before. So by going too far out in time, even if the underlying moves in your favor, your vertical will not expand as much as you would expect. Side note, also notice that with Apple here at 125, you're in what's called the theta positive territory, meaning over time, if Apple stays here, you'll make more and more money. Just look at the curves over time. They start shifting upwards towards the max profit at expiry. And that's because the premium from the short call is draining a lot faster than the premium from the long call, therefore allowing the spread to expand in your favor. Now, the opposite is true if Apple trades down at 115. Here, you're in the theta negative territory, meaning over time, if Apple stays here, you'll lose more and more money, and that's because the premium from the long call is draining a lot faster than the premium from the short call. The point in which you cross from the theta negative territory to the theta positive territory is simply the midpoint between the long and short legs, in this case 120. But let's save the details of that story for another day. The third reason why it might be hard to make money with debit verticals is if volatility increases from time of entry. When volatility approaches infinity, the delta of your options approach 0.5. Think about it. If a stock has become so volatile that it can literally be trading at any price in any moment, then every option in the chain has an equal chance to be either in the money or out of the money, so its delta is 0.5. When that's the case, your long and short options are going to be pretty much equal in value. And remember what I said about needing a larger delta difference between your legs to make money directionally? So the spread is not going to expand in your favor. So if you bought a vertical and then the stock begins behaving erratically and starts shooting up and down, causing the volatility to shoot up like crazy, or you bought a vertical in an expiration that includes earnings or some kind of news cycle, your spread is going to contract. And if your legs are in the money, you're actually going to lose money. Coming back to our lovely 115-125 long call vertical example for the September 18th expiry, I can actually jack up the volatility here. Watch what happens as I increase this, what happens to the P&L of the pink curve at Apple equals 125. It goes down. Notice also how all of the P&L curves start flattening out more towards the 0 line. So even if the underlying is moving in your favor and both of your legs are in the money, volatility expansion actually contracts your spread. Now, of course, if volatility contracts and Apple remains at this price, then your vertical spread expands in your favor. So those 3 reasons, combining a very narrow vertical with lots of time left and a pending news cycle in the underlying, and you've got yourself a triple threat, a vertical that is essentially not going to make any money. So what do you do if you actually want to make money with long verticals? Because that's what we're here for. We want to make money. Well, Look to cough up the initial debit and pay for a wider vertical, or look for verticals in a closer dated expiration, or both. If you cannot get a clear signal that the stock will move in your favor anytime soon in a closer dated expiry, and you're forced to buy further out in time, then look into coughing up the debit and widening the vertical. You can also consider buying a further out of the money vertical if you think that the underlying is going to move towards that out of the money vertical. Out of the money verticals are cheaper, which means you can afford to make them pretty wide. Finally, consider volatility. If volatility is going to remain elevated or worse, increase before your spread expires, look for a better expiry. A common mistake is to play the run-up into earnings with verticals. For example, buying a vertical with the intent of selling it back out as the stock runs up prior to earnings. Newer traders will soon learn that even though the stock is moving in their favor, they're barely making money on the vertical simply because the volatility remained elevated in both the long and short legs. So even though you're trading what seems like a harmless little spread called a vertical, or as the hooders like to call it, the debit spread, you still need to think about all of the Greeks involved. Again, just to summarize, that involves delta, direction of your vertical, highly impacted by the distance between the legs. Theta, time remaining till expiration, and vega, volatility, highly impacted by the volatility of the underlying and any upcoming earnings or news cycles. Alright, so that'll do it for this video. I hope this was helpful and gets you thinking about ways to optimize your vertical plays should you trade them. As always, if you have any questions or comments, feel free to leave them down below, and feel free to join us by checking out the links to our Twitter, Discord, and Twitch down in the description below. It's all free. We share our thoughts and trades and setups, entries, exits, all that good stuff, all that good commentary, and all those good vibes. But for now, stay safe, Brewer, and I'll catch you in the next video. Cheers.